So tell me what comes to your mind when you hear the phrase successful investor. Well, for many of us, it's maybe someone who has made a lot of money picking stocks or trading in options, or maybe a microcap investor. But as I found out from this article on Fool.com, by far the two biggest sources of wealth for most millionaires in the US is their primary residence and, of course, their long term retirement account. I think the same applies to India as well, which means a successful investor, per a revised definition, would probably be someone with a strong and stable investment portfolio. And that's exactly what we'll learn to do in this video as I take you through the many steps involved in constructing one. It doesn't matter if you're a beginner or a seasoned investor, because the principles and strategies I'll put forth today can be learned and relearned at any time. And over the years, I have made modifications, improvements in the way I allocate, in the way I pick funds, etc., which I'll definitely try to cover in this video. Also, much of what I'll be discussing will be centered around ETFs, exchange traded funds, although the portfolio build-up steps can be equally applied to actively managed mutual funds and to index funds as well. So why ETFs? Well, it's because of something I said in a previous video. The ETF universe in India has a wide range of options, and if an investor wants, he or she can make an entire portfolio out of these exchange traded funds. You can build a substantially large part of your portfolio just from ETFs, and I completely stand by it on account of how ETFs are designed, including the fact that as a basket of individual securities, ETFs are super diversified. Their expense ratio tends to be low. They are passively managed instruments. ETFs offer transparency, and it's easy to see what stocks, bonds, or other investments they're holding on a daily basis. One can trade them on an exchange, much like stocks. And most importantly, and in the context of this video, there are ETFs available for every market cap, sector, for factors like momentum and quality. For commodities like gold and silver, there are international ETFs and even debt ETFs covering government securities, corporate bonds, and other instruments. So I guess one can think of this video as part 2 of that ETF series I started a few weeks back. And in this way, we can learn a lot more about ETFs along with our primary topic, that is how to build a successful long-term investment portfolio. Let's begin. Now, unlike what many of us think, a portfolio is not merely a collection of assets. In fact, if done well, your portfolio can serve as a powerful wealth creation engine. And in my opinion, there are 5 steps of getting this right. The first step, and something that many of us miss out on, or at least we don't focus on it enough, is defining our investment goals. Now, this does not need to be complicated at all. After all, it's just 3 things. Number 1, decide what you're building your wealth for. Retirement, emergency, education, constructing a home, starting a business, and so on. Secondly, match each of these goals to a strategy. For example, money for a medical treatment is about preservation. Likewise, accumulating for your monthly household expenses is more of a cash flow exercise, while retirement definitely entails a growth strategy. So depending on the goal and its corresponding strategy, one can list out the ETFs that might be more suited to it. And in a way, it's also aligned to the investor's risk tolerance level, tagging them as safe, moderate, or aggressive. And the final step is to set up an investing workflow, which is 4 things. Write down your short and long-term goals, assign a timeline to each goal, check your progress at regular intervals, and of course, determine how much you need to save and invest every year. This might sound theoretical, but figure this: a relative of mine was worried about his retirement corpus, which, as we just learned, requires a growth strategy. This was way back in 2015 when he had a decent sum in his PPF account, and this analysis prompted a realignment wherein he withdrew a large chunk of that money and applied it to an equity instrument. To put this in numbers, the 1.5 lakhs that many of us invest every year in PPF over the last 10 years would now be worth some 24 lakhs, yielding a return of 7.7% for the investor, while the same money distributed monthly over 10 years in, say, the Nifty I ETF would have delivered a substantially higher corpus at 13.6% return. My point is, defining one's investment goals not only helps you keep track, but it acts as an inbuilt review system, ensuring the right investment is aligned to the right goal. If you're a little indecisive on the amount, for instance, how much money you should have for your retirement, then I'll request you to go through this video, and definitely the worksheet whose link is available in that video's description. This will give you a good approximate number of how much wealth you'll need when you eventually retire, and you can use the same worksheet for your other goals as well. So do try that out and build upon it. The second step in our portfolio creation process is the asset allocation bit, which simply said is a portfolio of investments consisting of stocks, gold, bonds, cash, real estate, crypto, etc. that reflects the investor's goals, time horizon and risk tolerance. So essentially, if you're a conservative investor with immediate goals, then you'll prefer holding safer assets like fixed deposits and cash. And if the tenure is long and your orientation is a bit aggressive, then there's likely to be a heavy dose of equity in your portfolio in the form of stocks, ETFs, and of course mutual funds. That being said, I'm not a big fan of putting 100% into equity or everything in debt. And if one recalls what I said in a previous video, the true goal of asset allocation is to improve your risk-adjusted return. That is, you either increase the returns for the same amount of risk or you lower the risk for the same amount of return. I even explained it with some numbers, and to everyone's surprise, including mine, a portfolio of 60% equity and the rest 40% in debt and gold gave me the same percentage of returns as one would have received with 100% equity, and the 60-40 combination came at a much lower volatility. So do watch that video, but yes, over time I have made some tweaks in my approach towards asset allocation, and a big change is that I no longer look at equity debt percentages like a 60-40 or a 70-30, which has immensely improved my portfolio's performance. Actually, let me explain this because this is a bit important. So let's say you're 50 years old and you have a 2 crore portfolio. Now for most 50-year-olds, a sum like 2 crores may not be adequate given that there are pending goals like a child's education, retirement home, etc. But if you go by the classical 100 minus age rule that many of the financial advisors put forth, then it means you should have 1 crore in equities and the other 1 crore needs to go into safer assets. But now let's assume your portfolio size is not 2 crores and instead let's say this number is 20 crores. So the big question is, should you then, in accordance with the 100 minus age rule, so should you then keep 10 crores in equities and the balance 10 crores in safer instruments? Well, in my view, no, and that's because there's a limit to what you really need in your portfolio as your safety assets. And for most people, 2.5 crores, maybe 3 crores in instruments like fixed deposits, a house, some gold, PPF, EPF should be more than enough. And the rest 17 crores could be deployed in more volatile but rewarding assets like MF, ETF, stocks, etc. I actually call this the safety cushion approach, and once you have a safety number in your head, I don't see any reason why the rest of the portfolio cannot go into more aggressive instruments, thereby increasing your wealth in the process. Now, people often ask me on how to arrive at the safety cushion number, and honestly, I don't have a scientific methodology for this. I think it's more about being comfortable with that number that you've chosen for yourself. But yes, if you come across a methodology for calculating it, then please do share it in the comments box below. But yes, definitely explore using the safety cushion approach as an alternative to the traditional percentage ratio method. And if you are having the slightest doubt, then never hesitate to seek the help of a financial advisor. The third step in building a successful investment portfolio is the portfolio structure. And this is where we bring together everything we have learned so far in the form of a simple yet powerful blueprint. The first exercise here is the alignment of goals and asset allocation. And if you do this right, your detailed layer should look something like this, which when translated to a simpler overview would come out a bit like this. So essentially, I have my safety cushion at the bottom that is made up of PPF, EPF, fixed deposits, debt funds, real estate, some gold, etc. While the larger part is my wealth goals that are taken care by a combination of equity and also some hybrid schemes. The second action step is to split the portfolio into a core and a satellite structure. I've discussed this in an earlier video, but very quickly, the core part of your portfolio should consist of foundational investments that offer stability to the portfolio. There is good diversification and has a low drawdown, which is best achieved via broad-based ETFs and even mutual funds, which can be actively managed and also index variants. On the other hand, the satellite part of your portfolio is where you take a bit more risk, or rather you can be a bit more adventurous, which typically happens with smaller but more targeted investments in specific sectors, regions or asset classes. The satellite's objective here is to capture additional growth opportunities and to also diversify the core holdings, for which again there are many ETFs and mutual funds that are available in different shapes and sizes. The split between core and satellite is another deciding factor, and I personally use an 80-20 ratio with an allowance of 5% in either directions. In fact, there are related decisions one need to take within the core portfolio itself. For example, in case of stocks, and why just stocks, even in the case of ETFs and MFs, the questions can include things like how many stocks or funds should I hold? Should I divide my investments equally, or should I allocate a different weight to each security, and things like that. These are decisions you have to make for yourself, but never be in a hurry. After all, investing is an evolving process and you're very likely to be tinkering with your own approach, as I have done over time, and believe me, it will get only better. But just to give you a pathway, here's how I have structured my investments based on my objectives, cash flow needs, and future goals. Notice here some of the experiments I do, and what gets featured in many of my videos is also visible here, and sometimes what may seem like an experiment actually is now a part of my core portfolio, like the momentum value strategy, and at other times some of it stays within my satellite structure, which is often a bit more tactical, it is a bit more concentrated, might have slightly zyada risk to it, and it definitely requires a lot more tracking and review. The next step relates to the selection of investments: mutual funds, fixed deposits, bonds, ETFs, stocks, etc. Now, when I first started my portfolio building process sometime in the year 2015, very honestly, my investments were all over the place. I was buying schemes left, right, and center, and like most of us, I was selecting instruments purely on the basis of the trailing returns. Okay, maybe some weightage was given to the AUM, the expense ratio, and the brand, but not much. And from some of the studies I have done on my channel, we now know that chasing historical performance is the perfect recipe for disaster. I'll say this is where I have made the biggest change, and my current portfolio follows, well, I'm just simplifying it, but it follows the basic 3x3 grid, where on one side I have the size of the underlying investment, so large cap, mid cap, and small cap stocks, funds, or ETFs. And on the other side, I have the style of investing, which, as you would have deduced from my previous videos, generally revolves around growth, value, and momentum. So see what I've done here? I've taken thousands of schemes, indices, ETFs, and stocks and put them into this simple grid, which makes my decision making a lot stronger and a lot more clearer. I'm not saying you need to follow the exact same system, but it's definitely to your advantage if you have something like this rather than picking random securities without any valid understanding of why one or the other is being picked. In fact, let me insert some ETFs here so that this part is super clear. So let's start with the momentum style of investing, and because I want something of this style to float on top of the large caps, I'll settle for the ICICI Prudential Nifty 200 Momentum 30 ETF, which is a combination of large and mid-sized companies with generally a higher weightage given to large-sized companies. For the mid-sized and small-cap companies, I can opt for the Nifty Mid-Small Cap 400 Momentum Quality 100 ETF by Mirae Asset, which perfectly fits into my structure and completes the momentum part of my portfolio. Let's move on to value, and there's one by Motilal Oswal that tracks the S&P BSE Enhanced Value Index, which is well aligned to what I'm looking for. And then we need the growth ETFs, and there are a bunch of them across market caps, including offerings from Nippon India, UTI, and HDFC Mutual Fund. So this is a bit dispersed, but if you want to stick to only one AMC, even that's possible, but you might not be able to fill every box, as you can see here. But I won't be surprised if over the next 2-3 years, most of the bigger AMCs introduce more such schemes and this grid of mine gets completely filled up. And it's not that you need to stick with just a 3x3 grid. For instance, you can take the size element a bit lower, so you create another row which can be used for microcaps. And similarly, you can add other investing styles like earnings quality, low volatility, and also international ETFs, which are available in all shapes and sizes. My point is, by having a format, a structure, the selection of securities or schemes or indices not only becomes a lot easier, the process itself becomes a lot more coherent. And in my case, wherein I follow the original 3x3 structure, it's definitely made my investing a lot more passive. That is, I really don't have to review my portfolio for months, in spite of using a big enough combination of ETFs, index funds, and also actively managed mutual funds to get there. So spend a couple of hours this weekend on understanding how you want to structure your portfolio, and believe me, once you are through with it, the researching and the selection of securities will be a lot easier and will also be a very enjoyable experience. The fifth and final step, and I'm sorry this video is getting a bit long, but if you think from my perspective, I'm summarizing something that took me 10 years to understand in some 20-25 odd minutes. Anyway, so the final step and a very important one is the entry and exit strategy. Now, since portfolio building is more about entry, so that's where I'll focus on. And the idea here is to keep it simple with a combination of SIPs and lump sum while giving respect to the valuations as well. For instance, the Nifty 50 at the time of recording this video is at a P ratio of 22.2, which seems fairly valued when I look at it historically over the past 20 years or so. Actually, let me show you a table I've compiled that explains the 1, 3, 5, 7 and 10-year rolling returns when one invests at different P ratio bands. It's very good information, and because we are now in the 21 to 24 P ratio band, one should typically expect a 9.5 to 10.5% return over a 5-year window. Actually, a bit more than that, as this number here is ex-dividend. So by including dividends, this estimated return number should be more like 12.5%, which is a pretty okay use case for investing. After all, it's inflation plus 6%, but I'll still recommend you take the SIP route when investing in any equity instrument. Now, let's say due to some reason, any reason, we see that the P band has come down to say 20, 19 or 18, then it opens up an attractive additional investment scenario, and one should definitely make use of lump sum investments to top up your portfolio. This is what I've generally done. So I've used SIPs deliberately, and when the valuations are in my favor, I have done lump sum insertions, and because the markets have been kind, my portfolio over the last decade has done really well and I'm happy with where it is. Okay, so when it comes to an exit strategy, I follow a very simple rule here. That is, if the conditions that allowed me to enter an investment have taken a turn for the worse, then that's the time I exit, or at least do a partial exit. For example, let's say I entered the Nifty when the P ratio was 19, so that was a great time to invest. And now let's say hypothetically the P ratio is 26, which is obviously a bad time to enter. Or if you choose to look at it differently, it is also a great time to exit your investment, or if not exit, at least one can cash in on the profits and do a partial exit from their stock, fund or ETF investment. The trick here is to do it as a system, and I've shared these studies in many of my videos, but I think if one does this entry-exit exercise as a deliberate system, then the chances of success really increases rather than doing it on an ad hoc basis or allowing your emotions to get the better of you. Again, much like everything I've discussed today, the entry and exit element is something you'll have to perfect over time. And if you give yourself a couple of years, I'm sure you'll get really good at it. Anyways, this is what I had in store for you in this video. And to quickly recap, we started off with the investment goals and learned how it determines your investment strategy and risk. We spent time on determining the ideal asset mix, and as your portfolio, I'll urge you to look at more viable strategies like the safety cushion method that I mentioned. Step number 3 is the portfolio structure, as we examine the importance of having a core structure for stability and also a satellite structure for our investing adventures. I then took you through the 3x3 grid, which if done well can almost pinpoint to you which ETF, mutual fund scheme or security you need to invest in. And finally, I presented the contours of a simple exit and entry strategy which one can build upon. Understandably, this wasn't a 25-minute topic, but I hope by sharing my own experiences in building an investment portfolio, I was able to keep this video relevant, practical, and informative for you. If you'd like to add anything to this or share your own experiences, please do use the comments box below, and also share this video with your friends and connections. Once again, thank you for your time. Do like this video, subscribe to my newsletter, and I'll see you very soon. Until then.